For years, the story of the artificial intelligence boom was simple. OpenAI built the models, captured the public's imagination, and dominated the market. Then, in 2021, their head of research, Dario Amodei, walked out the door. He took a team with him to build Anthropic, a competing lab strictly focused on safety and cautious development. This side-by-side bar chart shows exactly what happened next. By May 2026, Anthropic's annualized revenue hit $47 billion, towering over OpenAI's reported $25 billion. In a single spring funding round, Anthropic secured $65 billion in fresh capital, pushing their valuation to $965 billion. OpenAI took a decade to reach its current valuation. Anthropic did it in less than 5 years. The mystery is how a lab known for caution and safety somehow secured a lead measured in tens of billions of dollars. This crossing point arrives right at the edge of a massive liquidity event. Both companies are currently preparing to go public. They both build incredibly powerful frontier AI models, but their paths to commercialization are polar opposites. One relies heavily on consumer subscriptions and hype cycles, while the other builds quiet, deep utility for major corporations. Wall Street is about to price those two strategies. The market has to decide exactly how artificial intelligence translates into durable, long-term cash flow. Roughly 60% of OpenAI's revenue comes from consumers, paying for tools like ChatGPT+. It's a high-churn user base that typically cancels the moment a product cycle slows down. This dual pie chart comparison illustrates the divide. OpenAI is 60% consumer, while Anthropic is the inverse. 80% of revenue comes from major enterprise contracts. When you secure an enterprise client, you lock them in. Multi-year commitments and deep software integration create massive switching costs. A company tightly woven into an enterprise's daily operations simply doesn't churn like a bored consumer. That makes Anthropic's annualized revenue mathematically higher quality and far more durable over time. Anthropic didn't capture that enterprise base by accident. They built a specific hyper-growth engine called Claude Code, an AI-assisted coding agent launched in May 2025. Within 9 months of its release, Claude Code reached a $2.5 billion annualized run rate. The number of companies spending $1 million or more annually with Anthropic doubled in less than 8 weeks. That single piece of software triggered a massive corporate migration. In roughly 1 year, Anthropic's share of total enterprise AI spending ballooned from just 10% to over 65%, pulling clients directly away from OpenAI. Autonomous agents reached a level of reliability that converted them into buying center products, tools that move beyond the personal desks of developers and into the core budgets of global enterprises. Generating revenue is only half the equation. The other half is the staggering cost of running these models, what industry insiders call a vertical wall of demand for computing power. OpenAI is burning cash at an astonishing rate. They are currently running a negative 122% operating margin, and internal projections estimate their training costs will hit $125 billion by 2030. This dual-axis line chart tracks OpenAI's massive $125 billion projected compute spend against Anthropic. Anthropic projects only $30 billion in training costs over that same period, all while maintaining gross margins on inference infrastructure above 70%. Anthropic didn't win by brute-forcing scale at any cost. They mastered the unit economics of artificial intelligence, generating nearly twice the revenue of their biggest rival while spending 4 times less on compute. The broader software industry recently found out exactly what that kind of efficiency looks like when it's pointed at their market. Urgent tone. This cascading red line chart captures what traders are calling the sauce-pocalypse. Over 2 days in February, $285 billion in market capitalization was wiped out across a basket of traditional software, legal tech, and financial services stocks. The trigger for that massive sell-off was remarkably small. Anthropic simply released 11 open-source legal and compliance plugins for its Claude Cowork agent. They didn't launch a polished product, just free code on GitHub. The panic suggests a new market consensus. Foundation model companies are becoming direct competitors to traditional software incumbents. When an agentic tool can perform the core functions of a legal tech firm for free, the value of the incumbent's entire ecosystem is called into question. Now, an IPO supercycle is looming. Mega listings from companies like Anthropic, OpenAI, and SpaceX are set to absorb massive amounts of market liquidity. When those offerings hit the market, institutional investors will have to make a choice. Fund a cash-burning, consumer-heavy model, or back highly efficient, deeply integrated enterprise lock-in. Capital efficiency, safety guardrails, and deep business-to-business workflow integration prove to be the actual durable moats in the AI era. Anthropic enters the public market as a near-trillion-dollar juggernaut. Their arrival forces a reckoning for every other company in the sector, as the market begins to decide which traditional software giants can actually withstand a competitor that builds for safety, efficiency, and scale all at once.